Tuesday, June 29th, 2021, Maneko 64, home of alternative economics and contrarian views. Today we're going to talk about the real estate market and how crazy the world is that during a pandemic, the housing market, the real estate market, not only in the US but in Europe, is going up like a rocket. Prices are that is. There is a real estate bubble out there, and you'd think, how can that be when people are on furlough, when the hospitality, travel industry, the hotel industry, restaurant industry, everything is like, yes, under threat of disappearing. UK house prices have grown at the highest level since 2004. Yes, we hear a lot of times that the reason why house prices go up is because there's not enough houses, there are too many immigrants, too much demand, but no one ever talks about the real reason for the rise in house prices, and that is the manipulation of interest rates by the central bankers. Manipulation lower, of course. The Fed is buying about $40 billion of mortgage-backed securities every month. The European central banks, like the ECB, the Bank of England, are doing the same. They're keeping mortgage rates artificially low. And why is that? Well, because Western economies have become a joke, really. They've become credit-induced machines, and they need to keep the consumer whole. I guess it's the old saying of the wealth effect. If your house is worth $1 million, you feel wealthier than if it was worth 100. Especially if you don't have a job, especially if you're finding it hard to pay your bills. People, they use that equity in their house to take out even more loans to keep things going. And it's really amazing that we have people like Fed President Eric Rosengren coming out that saying U.S. cannot afford a housing market, boom and bust, warns Fed official. So we have the guy here who's creating this, the people who are creating this warning about it. It's just ridiculous and preposterous. Yes, I get a lot of questions from people on the channel about hyperinflation. If we were to have a hyperinflation, wouldn't my mortgage be written off? Yeah, that's a possibility. I wouldn't argue against that. But I would say that during a hyperinflation, you might be in your home, you might have a mortgage, but you might not be able to pay your real estate taxes or your council taxes, as they call it here in the UK. And you might lose your home. You might not even be able to service your mortgage when there is a hyperinflation, because you won't have money that will enough money to buy anything, let alone to pay off your mortgage. So I would think twice. In Germany, in this book here, When Money Dies, it talks about that. And on page 226, it says how they reinstated mortgage valuations to 25% of the value of the pre-hyperinflationary values. So yeah, they won't let you get away with it totally. On the flip side, the deflationary collapse is actually worse, I would say, because what happens then is that the value of your house drops. Your mortgage, the mortgage that you have remains the same, and you have negative equity. And unless you have a job and you're paying that off, you're going to be in debt. And in some countries you can walk away, like in the US. In the UK, I don't think you can walk away. you'd have to negative equity, you'd have to declare bankruptcy, I would say. So it's all a very dangerous situation, I would say. And I'm not saying I never had a mortgage, but my motto has always been pay off your debts, pay off your mortgages as quickly as possible, and be independent, be self-reliant. Of course, as Lynette Zhang says, even when you pay off your mortgage and you supposedly own your home, it might be taken away from you because of real estate taxes, because of council taxes. So nothing's ever certain in life, but I think the best way to go about it is to try to pay off your mortgage a lot. Try not to leverage yourself too much. Try to keep that loan to value ratio low. Don't borrow 95% or even 100%. I'm hearing that that's coming back, 100% mortgages, which is crazy in my opinion. You see here, house prices climbed to record levels in US and Europe. US existing home prices jumped 23% year on year in May to an average of 350,000. In the UK, just came out this morning, UK house prices rise at fastest pace since 2004, according to nationwide house prices. It's just another example of interference in the free market. Not to say that in a free market where there are no central banks, there won't be booms and busts, but these are more accentuated. And you would have thought back in 2008, after the huge housing collapse, that people would learn the lesson, but unfortunately people's memories are very short. Yes, this is something that we need to keep an eye on. And what should young people do, or even people that are not that young anymore, who can't get on the housing ladder, as they call it in the UK? The only thing I would say that I would be doing is keep renting. I know when you rent, you're dependent on the landlord, but at least you can walk away with no obligations. Unless, of course, you own some back rent. The other thing is try to move somewhere where real estate values are lower that you can afford. Yeah, that's the only thing I would say. And live within your means. Try to save as much as possible to keep paying off your mortgage as much as possible. But yeah, the only reason this is happening is because of the central bankers. It's the accommodative policy of the central bankers. Yeah, and the best thing that could happen really for young people that want to buy a property would be a deflationary collapse or a collapse of the real estate market. But you can bet that the central banks and the politicians are not going to allow to happen that completely, because they want to be reelected, the politicians, and they are in cahoots with the bankers. So with that, let's quickly look at where the markets are this morning. It's 5 to 9 a.m. London. The gold and silver market are still in that very tight range. Not much direction. And I noticed as well that yields dropped quite sharply yesterday for longer term treasuries. That's despite the fact that the CPI rate, inflationary pressures have grown. What this might be telling us is that bond investors are not too confident about the economy. They think inflationary pressures are going to subside in the long term. They could be right about the economy, but they might be wrong about inflationary pressures. We could have a stagflationary environment, and I think very few people in the markets remember that. What happened in the 70s, people who were in the markets back then, they're even older than me, even though I do remember the stagflationary periods. So things are very confusing right now, I would say. I saw yesterday as well, the Dow dropped, but the NASDAQ made, I think, all-time highs, or it was up very strongly. It's all topsy-turvy, I would say. So right now, spot gold is at 1774, down about $4. Range has been 1779 to 1772, so a narrow range. Silver trading at 2603. Range has been 2594 to 2615, so very narrow range. I think 2630 to 50 is really a big resistance here for silver. Gold as well. I think every time it gets to around 1790, it comes right back down. It's been like a Groundhog Day, as I said a few days ago, these precious metals market for now. The Dow futures up 50, S&P is down slightly, NASDAQ futures down 26. The currencies, the pound is down about 0.2% at 138.59. The euro is unchanged at 119.13. The dollar is unchanged versus the yen at 110.67. And the dollar yuan is at 645.80. So we had gotten back up to around 650 and we're turning back down now. So it looks like the dollar has topped versus the yuan at least. The Aussie dollar is at 75.48. That's down 0.25%. I think yesterday we almost got back up to 76. General commodities, WTI crude has come off a bit. Yesterday we got up to around just above 74. We're now at 72.74, up about 1/8%. High grade copper is down 1% at 423.50. And as I said, yields dropped quite sharply yesterday. That means that bond prices went up, and these were like yields from around 7 to 30-year. Right now, the 10-year yield is below 150. It's up 1 basis point at 149. So why are the 10-year yields so important? And the fact that they're going down? Well, it's going to drive mortgage rates as well. Mortgage yields, mortgage-backed securities will follow. Their yields will follow treasuries lower. The 10 or 30-year mortgage rates will go down, maybe not as much as treasuries. And also the fact that the Federal Reserve is continuing to do QE. So is the Bank of England. So is the ECB. That's going to keep, that fire under the real estate bubble that people need to be careful with. We know what happened in 2008 when the real estate market collapsed, and it could do the same again. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.